So, let's be real for a second, £1,000 doesn't sound like a lot of money to start investing with. It's the cost of a new iPhone, maybe a weekend trip to Paris, or a month of groceries if you're really stretching it. But here's the thing, that same £1,000, if used wisely, can be the foundation of long-term financial freedom. The problem? Most people either do nothing with it or blow it on something that loses value the second they buy it. Today, I'm going to show you exactly how to turn that £1,000 into a diversified UK investment portfolio, one that's built to grow, protect your wealth, and make your money work for you, all without needing to be a financial expert or millionaire. And yes, we're doing this from the perspective of a UK investor, not the American open a Roth IRA type of advice you hear all over YouTube. We'll be talking about ISAs, UK-based ETFs, UK brokers, and everything that makes sense for someone investing right here, in pound sterling. And by the end, you'll not only know where to invest, but also why each piece of your portfolio matters, and how to make that £1,000 actually grow. So, let's break this down step by step. Before we throw money into the stock market, you need to understand you. Because the way you invest £1,000 depends entirely on what that money represents to you. Ask yourself a few questions. Am I investing this money for the long term of like 5, 10, or 20 years? Or am I hoping to make a quick profit in the next few months? Would I panic if my £1,000 dropped to £800 next month? Or would I see it as an opportunity to buy more at a discount? If you're someone who can't sleep when the markets drop, you'll want a portfolio that leans a bit more conservative, maybe more bonds or cash equivalents. But if you're in your 20s or 30s, with decades ahead of you, you can afford to take more risk because time smooths out volatility. Here's the truth. The worst mistake new investors make isn't choosing the wrong stock. It's choosing the wrong mindset. They expect overnight results, chase hype, and panic when prices move. But the best investors understand that wealth builds quietly, through patience, discipline, and consistency. So before you even click buy, set this mindset in stone. You're not trading, you're building wealth. Alright, now let's talk about where to invest this money, because in the UK, this one decision can literally save you hundreds, even thousands, in taxes. You've got a few main options. Number 1. Stocks and shares ISA. If you're in the UK and not using an ISA, you're missing out. It's one of the best financial tools available, period. An ISA, individual savings account, lets you invest up to £20,000 per tax year, and any profits, whether from dividends, interest, or capital gains, are completely tax-free. So if your £1,000 grows to £10,000 over a few years, you don't owe a single penny to HMRC on that growth. That's why every UK investor should start with an ISA. Platforms like Trading 212, Freetrade, and Vanguard Investor UK all offer stocks and shares ISAs. If you don't have one yet, honestly, that's your first step. Open one today. There's even a link in the description to compare ISA providers that offer commission-free trading. Number 2. SIPP, Self-Invested Personal Pension. If you're thinking really long-term, like retirement, then a SIPP is another great option. It's like a personal pension where you control your investments. The main advantage? Tax relief. For every £80 you contribute, the government tops it up to £100. That's a 25% instant return, before your investments even start growing. The downside? You can't access the money until you're at least 55, soon to be 57. So SIPPs are fantastic for long-term wealth, but not if you'll need that cash anytime soon. Number 3. General Investment Account, GIA. This is the most flexible. You can invest as much as you want, withdraw anytime, but it's not tax-sheltered. So if you've maxed out your ISA or SIPP, then you can use this. Otherwise, it should be your last choice. Now let's talk about diversification, the thing that keeps your portfolio alive when markets crash. Diversification is simply not putting all your eggs in one basket, or, in investing terms, spreading your £1,000 across different types of assets so you're not overly exposed to one risk. A properly diversified portfolio protects you from volatility while still letting your money grow. So here's how I'd break it down for someone starting with £1,000 in the UK. Step number 1, core index funds, 60%. This is the foundation of your portfolio. For most investors, it should make up at least half of your money. And when I say index funds, I'm talking about ETFs that track broad markets like FTSE All-World, e.g., Vanguard FTSE All-World UCITS ETF, ticker VWRL. S&P 500, e.g., iShares Core S&P 500 UCITS ETF, ticker CSP1. FTSE 100, e.g., Vanguard FTSE 100 UCITS ETF, ticker VUC. These funds give you exposure to hundreds or even thousands of companies around the world, instantly diversifying your £1,000. For example, if you put £600 into something like VWRL, you're investing in companies like Apple, Microsoft, Nestlé, Unilever, all in one go. You're not betting on a single winner, you're betting on the global economy. And historically, global markets have returned around 7 to 10% per year over the long run. Step number 2, bonds or fixed income, 20%. Next, you want some stability, that's where bonds come in. Bonds don't grow as fast as stocks, but they're less volatile. You could put around £200 into something like the iShares Global Government Bond ETF, IGLO, or Vanguard UK Government Bond ETF, VGOV. If markets drop, bonds usually soften the blow. Think of this part as your portfolio's shock absorber. Step number 3, real assets, rights or commodities, 10%. To add another layer of diversification, you can include rights, real estate investment trusts, or commodities like gold. For example, iShares UK Property ETF, IUKP, for exposure to commercial property. SPDR Gold Shares, GLDA, for gold. Allocate maybe £100 here, it's a small but important hedge against inflation and uncertainty. Step number 4, a cash reserve, 10%. Finally, keep £100 in cash either in your brokerage account or a high-yield savings account. This gives you flexibility, maybe to buy more during a dip or cover emergencies. The key thing is, you don't want to be forced to sell your investments when you need cash. Now that you know what to invest in, let's talk about where to do it, because your choice of platform matters. Here are some of the top UK investment platforms for beginners with £1,000. Number 1. Trading 212. Probably the most popular option for new UK investors. Why? Commission-free trading, fractional shares, and a clean, easy-to-use app. You can open a stocks and shares ISA, and even invest in ETFs with as little as £1. You can literally start with £10 or £100 and still get exposure to companies like Apple or ETFs like VWRL. Plus, Trading 212 often runs promo offers, where if you sign up with a referral link, like the one in the description, you get a free share worth up to £100. Number 2. Freetrade. Another UK-based app that's great for beginners. It also offers commission-free trading and a stocks and shares ISA, but the range of ETFs and international stocks is a bit smaller than Trading 212. The interface is beginner-friendly though, and it's regulated by the FCA, so your money's protected up to £85,000 under the FSCS scheme. Number 3. Vanguard Investor UK. If you prefer a more set-it-and-forget-it approach, Vanguard is your best friend. They focus on low-cost index funds and ETFs, and you can open both ISAs and SIPs directly with them. The only downside is that Vanguard has a minimum investment of £500 for a lump sum or £100 per month if you go the regular investment route. But their fees are extremely low, about 0.15% platform fee and 0.2% average fund fee, which is way cheaper than traditional brokers. Number 4. eToro UK. If you want exposure to both stocks and crypto, eToro is a solid multi-asset option. You can invest in fractional shares, trade ETFs, and even copy other investors through their copy trader feature. They've also introduced ISA integration through MoneyFarm, so you can now use eToro for tax-efficient investing too. Just make sure to check fees and spreads before trading frequently. Alright, so now that you've picked a platform and understand where to allocate your £1,000, let's actually build your portfolio and set up a system that runs almost automatically. Because here's the truth, your success in investing won't come from finding the next Tesla. It'll come from building a structure that compounds quietly while you live your life. So let's break down how to actually set this up. Step number 1, open your ISA account. As I said earlier, the Stocks and Shares ISA should be your go-to for investing in the UK. Head over to your chosen platform, say Trading 212 or Vanguard UK, and open an ISA account. It'll only take a few minutes, and once you're in, you'll see your dashboard where you can start depositing funds. Deposit your £1,000 and let's move to the next step. Step number 2, choose your ETFs or funds. Now comes the fun part, actually buying your investments. If you're going the ETF route, which I highly recommend for beginners, here's what your basket might look like. £600 Vanguard FTSE All World ETF, VWRL. This gives you global exposure, over 3,500 companies in 50+ countries. You'll get diversification across tech, healthcare, finance, and consumer sectors. £200 Vanguard UK Government Bond ETF, VGOV. Add stability and balance when markets get volatile. £50 iShares UK Property ETF, IUKP. A small exposure to UK real estate. £50 SPDR Gold Shares ETF, GLDA. A simple inflation hedge, because when currencies fall, gold often holds value. £100 Keep in Cash or Money Market Fund. Use this as a flexibility fund to buy dips or rebalance later. This setup gives you exposure to the entire global economy, bonds for safety, real assets for stability, and some cash to adapt. Step number 3, enable auto-invest or regular contributions. The biggest secret in investing? Consistency beats timing every single time. If your platform allows it, like Trading 212's Auto-Invest or Vanguard's regular investment plan, set up a monthly deposit, even if it's just £50 or £100. That's called dollar cost averaging, or pound cost averaging, buying regularly, no matter what the market's doing. When prices drop, you automatically buy more shares. When they rise, you buy fewer. Over time, this smooths out volatility and builds your portfolio on autopilot. If you only invest once, your £1,000 can grow. But if you keep adding monthly, it compounds into something much bigger, and that's where real wealth starts forming. Step number 4, rebalance once a year. As markets move, your allocations will change. Maybe your global ETF grows faster than your bonds, suddenly your 60-20 or 10-10 split might become 70-15 or 10-5. That's normal. Once a year, review your portfolio and bring it back in line with your target allocation. You can do this by selling a bit of what's overweight and buying what's underweight. It's like maintenance, not exciting, but essential to stay balanced. Step number 5, track, but don't obsess. It's tempting to check your portfolio every day, especially when it's new. But remember, the market rewards patience, not panic. Checking your portfolio too often leads to emotional decisions, selling low, buying high, chasing trends. Instead, make it a habit to review your investments quarterly or twice a year, just to ensure your plan is on track. Set and forget, that's the Graham Stephan way. Now, before we get too confident, let's talk about the traps that most beginners fall into, are the ones that quietly destroy returns. Mistake number 1. Chasing short-term hype. Every few months, the internet goes crazy over some next big thing, whether it's AI stocks, crypto, or penny shares. The problem? Most of these plays are speculation, not investing. Investing is like planting a tree, you nurture it over time. Speculation is gambling, you might win once, but over time, the house wins. So ignore the noise. If you can't explain how a company makes money in one sentence, you probably shouldn't invest in it. Mistake number 2, ignoring fees. Fees are the silent killer of compounding. That 1% management fee might not sound like much, but over 30 years, it could cost you tens of thousands of pounds. Stick to low-cost index funds, ideally under 0.3% per year. Vanguard, iShares, and Fidelity all have solid low-fee options for UK investors. Remember, every pound you save in fees is a pound that keeps compounding for you, not someone else. Mistake number 3, not using your ISA allowance. Every UK adult gets a £20,000 annual ISA allowance. Use it. If you're investing outside an ISA, your gains could be taxed at 10 to 20% for capital gains and up to 39.35% for dividends if you're in a higher bracket. That's like giving away free money to HMRC every year. Don't do it. Always prioritize ISA or SIPP first. Mistake number 4, timing the market. Even professional fund managers can't predict where the market will go next month. So if you think you can, you're kidding yourself. Here's what works. Invest consistently, ignore short-term noise, and focus on time in the market, not timing the market. As the saying goes, the best time to invest was yesterday. The second best time is today. Mistake number 5, forgetting emergency savings. Never invest money you can't afford to lose short-term. Before investing, you should have 3 to 6 months of expenses in an emergency fund, preferably in a high-interest savings account like Chase UK, Revolut, or Moneybox. That way, if your car breaks down or you lose your job, you don't have to sell investments at a loss. Investing is for long-term goals. Emergencies are for cash. Don't mix the two. Now let's talk about what really makes people wealthy over time, compounding. Because the truth is, you don't need to earn 6 figures or win the lottery to become financially independent. You just need to understand the power of time. Let's put this in perspective. If you start with £1,000 and invest £100 per month into a diversified portfolio earning 8% per year, in 20 years you'll have around £58,900. In 30 years? Over £140,000. And your total contributions would have only been £37,000. The rest, over £100,000, comes purely from compounding growth. That's the secret that most people miss. Compounding doesn't care if you start small. It only cares that you start early and stay consistent. That's why your first £1,000 is so powerful. It's not about the amount. It's about building the habit. That habit compounds into wealth, and wealth compounds into freedom. So what happens after your portfolio starts growing? Once you hit £5,000, £10,000, £50,000, your strategy should evolve. Here's what to focus on. Number 1. Expand your asset classes. You can start exploring international ETFs like emerging markets, small cap funds for higher growth potential, REITs, corporate bonds, or even private equity funds once you're more experienced. But remember, never abandon diversification for the sake of excitement. Number 2. Consider dividend stocks. Once your portfolio grows, you can build a small section for dividend-paying stocks. UK companies like Unilever, ULVR, Diageo, DGE, or National Grid, NG, have solid, consistent dividends. Reinvest those dividends automatically. That's how you turbocharge compounding. Number 3. Use SIPP for long-term tax efficiency. Once your ISA is maxed out, or if you're saving for retirement, move extra contributions to a SIPP. That 25% government top-up is free money you can't ignore. If you're self-employed, platforms like Penfold, AJ Bell, and Interactive Investor make SIPPs easy to manage. Number 4. Automate everything. The best investors automate. Set direct debits to your ISA or SIPP every month. Automate dividend reinvestment. Automate transfers to your savings. The less emotion involved, the better your results. Number 5. Keep learning. The financial world changes, new ETFs launch, new tax rules emerge, and markets evolve. Follow UK finance creators, read reputable sources like Money Expert, Foot Advisor, and watch channels that break down complex investing into simple actions, just like this one. The goal isn't to predict the future, it's to adapt intelligently. So, let's bring it all together. Here's your roadmap for building a diversified UK portfolio with £1,000. Mindset: think long-term, investing is a marathon, not a sprint. Tax wrappers: start with a stocks and shares ISA, then look at SIPP later. Diversify: use ETFs to cover global stocks, bonds, and real assets. Platform: choose trusted ones, Trading 212, Vanguard, or Freetrade. Consistency: invest monthly, don't time the market. Avoid mistakes, stay away from hype, minimize fees, and build an emergency fund. Compounding: let time and consistency work their magic. At the end of the day, your first £1,000 won't make you rich. But it will make you an investor, and that mindset shift is priceless. Because once you start seeing your money work for you, instead of the other way around, you'll never look at spending the same way again. So if you're ready to start, check the links in the description. I've listed my top UK investment platforms like Trading 212, Freetrade, and Vanguard, along with a few guides that'll help you compare fees and open your first stocks and shares ISA. And if you got value from this, don't forget to hit the like button, subscribe, and turn on notifications. It really helps the channel grow and lets me keep creating videos like this. Remember, your future self will thank you for starting today. With that said, thanks for watching, and until next time.